we're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts there on the show. We have, let's welcome our experts, Kalra of Target Investing, Vinit Bolinjkar of Ventura Securities, and T.S. Harihar of HRBV Client Solution join me on the show. Many thanks to all of my guests for joining me. On the show today, we ask our analysts if there is a sector in which, they can accumulate a basket of stocks to mitigate the risk. So which is the sector that they're bullish in for FY20? Rail Industries has seen a big sharp over the last 1 month. We ask our analysts what's aiding the rally. The other unlikely outperformer this time around has been Tata Motors. We asked them, has there been any change of fundamentals to cause the rally, and what's their view on the counter? And finally, a lot of movement has happened. Infosys on the downside and TCS on the upside post the numbers. We ask our guests what they believe and what should be the pecking order in the large cap IT. But let's start with the sectoral pick. It's FY20. A lot of sectors have moved. So Hari, a sector in which you believe that wealth will be created in this sector, and not one stock, but a basket of stocks in this sector that can be accumulated to mitigate this risk. Which is the sector that you like?
See, from a one-year perspective, we're actually looking at two broad sectors. One, of course, the consumer space, where we feel that probably what we call smart beta, slightly more than the market returns you can expect. We don't expect a great outperformance, but I think if you look at the post-election scenario with the new government in place, consumer demand, rural demand, I think the consumer space probably looks to be the best bet over the next 1 year. So within the consumer space, we like stocks like Britannia, we like Havels. I think a very, very strong play on the consumer, what we call consumable side. The other sector we like is PSU banks, and I think PSU banks probably have taken a little bit of hit in the last few days because the amount of money that was supposed to come in from LC and NCLT, I think that has got delayed. So that has worked a little against the sentiments. But I think that should probably get resolved over the next 2 or 3 months. And we should see at least about 60-70% of their problems getting sorted out in this year. So, we believe that banks like BOB, of course, the largest one, SBI, these look to be good. So broadly, we would look at PSU banks for alpha and probably consumer stocks for what we call smart beta.
Okay, so just a couple of follow-up. You believe that valuations are fair for the consumer stocks because, counters like Havels or Britannia, they still trade at premium valuation. While the mid-caps haven't moved, the markets are at record high. So probably the fear of a correction always remains there. And for the PSU banks, the rally has already been there. So you believe that they are still undervalued, that someone should take a bet on them?
PSU banks, yes. I think if you look at the PB of PSU banks compared with the private banks, and especially considering that credit growth has been about 13.3% in the last year, I think PSU banks to me look even after the small rally that we've seen, it looks to be extremely underpriced. So I wouldn't worry much about PSU banks. Consumer goods, I agree with you. I think valuations have been a concern, but then that is a kind of valuation they've been quoting at for as long as I remember. So I don't think that is going to change. That's why I call them smart beta. So they would probably give you a little more than the market, no great outperformance. But I think that is where I would believe that the downside risk is the lowest among all the sectors.
Okay, so that's the view that's coming in consumer sector as well as PSU banks. Vinit, what's the sense? Which sector you are betting on? Which are the stocks that you believe should be nibbled into from this sector that can generate decent returns for this financial
So I
year?
think chemicals is a clear sector to go to. We have issues in China, and we are seeing migration of clientele coming to India. India is getting increasingly a preferred destination. One is the pollution impact, and two is the costing and quality of Indian product. So in these, I think the pecking order would be Deepak Nitrite, Aarti Drugs, and Heikel Chemicals.
Okay.
So we like these three stocks primarily because we are seeing some very good growth coming in across the three stocks. Close to doubling of EPS, margin expansion, ROE expansion, and they've got their own niches in all the segments. So there's significant margin of safety, and there is good resilience to any kind of threats. Given that kind of thing, I believe that these three stocks are available at very low teen multiples, and with the growth being there, I think these stocks can really do well.
Okay, so let's talk about them individually. Deepak Nitrite, what are you betting on? Are you betting on the phenol plant?
So the phenol and acetone,
okay.
There's a force major in the European, one of the large guys. So we'll see growth coming in, and they're getting into downstream also. Capacities are being put up. So they're catering to the entire value chain, diversifying, and the other segments also doing well. So we'll see, we have seen a big quantum jump in profits this year, and next year is also expected to be equally strong. And what is important is that it's a import substitute for the Indian markets. So to that extent, volume growth is not an issue, and revenues hence will be very intact.
Okay, the other two are basically also plays on APIs, which is probably Hykel, which also has chemicals, and there is Aarti Drugs. Now, Aarti Drugs, what are you betting on? Because the US market probably is still off limits for them.
So, in the worst of scenarios, they still have one of the best EBITDA margins, which is around 16%. And we are expecting that 1400 crore revenues can easily scale up to 2000 by FY22 in 3 years' time. And we believe that a lot of time has gone by since the import alert, and they've done a lot of remedial measures. So anytime the US market could open up for them. So they are ripe for getting an upgrade, and if that comes in, margins will really expand.
Okay.
So we believe in this kind of scenario, the stock is available at 11 PE on 2-3 year earnings out. So I think a great quality stock, good ROE, they're the lowest cost and the largest manufacturers of many of the products. 10 products contribute to 75% of revenue, so it's a well diversified portfolio. So good growth, decent, one of the best margins, and room for upside.
What's the story with Hykel?
Hykel, see, it's more of a pharma and agrochemicals kind of space, and they do a lot of innovator assistance also. So they do research, they do CRAMS, they do CRO and all the activities, and they're very well integrated in that. And they've undertaken a new strategy of not just focusing on CRO, but they want to do contract manufacturing also.
Okay.
So with the existing client, they have a substantial relationship of a very long period of time. And they've made inroads into the Japanese market, the US market. They're compliant everywhere. They are RX 360, one of the Indian companies to get qualified for that. So, quality is very paramount in the pharma and the agrochemical space. So, people don't mind paying a little more for the production. And we believe that the margins will continue to improve. We have got good growth, mid-teens kind of growth environment. And the stock is pretty reasonably valued. So we like that.
Okay, so Deepak Nitrite, Aarti Drugs, as well as Hykel are the stocks that Vinit spoke about. Samir, what's the sense? Yeah. Which sector are you betting on for FY20?
So I think for us, FY20 is about real estate sector.
Okay.
We believe the inventory levels at the premium and the ultra premium are sliding down because the newer project approvals are going down in the premium end. So, and the sales are picking up. And if you see, the completion of certain premium end projects are about 2021. So that completion will bring out more recognition of revenue as well on the P&L of these companies. So over there, we are picking up Oberoi Realty as our topic. I believe the cash-rich company and net cash. And if you see, there two big projects have come up. One is in Worli, which will get revenue recognition in next couple of quarters, and that's around 2,000 crore kind of a revenue. The other will be Borivali, which is around 25% recognized, which will go to 50% by FY20 first half. So that I see as a big churn in the company. And because of the mid-level developers facing certain issues with funding, I see certain acquisitions as well in the land, and land getting cheaper because less competitive bids will come in. So I think that rationalization will pick up the real estate sector.
Which other stocks in the real estate? Because
so I think if you see on the corporate side, I think commercial side, Phoenix Mills is the another which we have, because the revenues from the rentals is going up, the footfalls are increasing in the malls. PVR has done a lot of tie-ups at their malls. There are 2 malls coming up newly in next 6 months. and they have a good amount of funding as well. So I don't see a issue over there. So commercially, I like that.
Okay, so that's the view that's coming in. Phoenix Mill as well as Oberoi Realty are the stocks that Samir spoke about. Next stock we want to discuss is Rain Industries. It's rallied almost 20-30% in the last few days. Today it's managed to stay soft, and a couple of reasons that came out was some positive comments in the annual report. The bonds that did manage to rally. One of their key peers in the US, that is Coppers, that actually managed to rally. So things seem to be turning out. You can see the yellow line, that was the bond that rallied ahead of the equity market. So there is traction that's happening. That's the bond of Rain Carbon, the US subsidiary. So what's the view on Rain Industries and what's causing this rally? Vinit, any sense of what's happening with Rain? It rallied from 50 to 400 and then came back to 100. Now again the rally seems to be starting. So should someone get in this rally, or it's an avoid?
So frankly speaking, we don't track it very actively. So me guiding on the stock would be not right. But I believe that it's still a wait and watch kind of story, and we would want further clarity on all the the pricing trends. Last quarter the volume trends were down. Right now we have some growth coming in, but still we would be waiting on that stock.
Okay, Samir, what's the sense on Rain Industries?
So I think their annual report came out, and that talked more of restructuring the issues and reducing the leverage which they have. I think leverage is the main concern of a lot of investors who are stuck into it and who want to get in. So if that takes through in next 6 months or next 9 months, I would like to see that first. And secondly, if you see they have a pet coke issue. They import pet coke, and Supreme Court had already given a limit over it. So I think that would have exhausted by March. So they have another couple of months to work on. So there the capacity utilization might come down again. So a March quarter may turn a profitable quarter again. So that can be another driver which was. And secondly, the valuation really went cheap. And I think these three things are making it go into a speculative rally rather than a fundamental base rally, but I'll not take a position.
Anything else interesting that you saw in the annual report that like I went to the annual report, they spoke about restructuring, they spoke about normalized earning coming into FY19 again, for FY20 again. So they gave a lot of positive commentary. Anything else that you spotted?
But if you see the balance sheet is getting stretched. If you compare the September balance sheet with the March balance sheet, the receivables have increased by 15% within that 6 months. So I think this US sales, even if it's picking up, it's not converting into the cash flows, which is very important for Rain Industries right now, because they really need to deleverage, because 80% of their debt is into working capital. So I think that has to really figure out for an investor to take a long-term bet on it.
Okay, that's the sense. Hari, what's the sense on Rain Industries?
We like the stock, I think, more from a pricing point of view. I think there are a lot of issues pertaining to coke, CPC over the last few years. But I think what we like is that, number one, if you look at the cement business of Rain, which is what they call the Priyadarshini cements and the brand in which they sell, I think South actually has been one segment where the cement prices have been a little buoyant compared to the West or the North. So I think that should probably work in their favor. Number two, I think if you look at it purely in terms of valuations, here is a company with about 24% ROE, 17.5 times ROC, and I think the P is about 7.5 or 7.6. So in terms of valuation, I don't think there's much of a concern in the stock. And if you look at the price, I think we have seen a small rally, but then if you look at it from its peak, it's still about 60-65% lower than the peak price. So definitely, I think the downside risk seems to be limited. So we would be probably looking at buying, not a very long-term investment point of view, but definitely I think as a short-term trade, we would look at buying Rain.
Okay, are you concerned about the debt situation? Because time and again they've done it. Whenever they get their debt down, they do a leveraged acquisition. They did it last time with Rutgers. Do you think that they will actually, they're never able to get their debt down? Is that a concern that you have?
that's a problem, I think, with most of the companies in this segment. It's basically, I think, a lot of debt-hungry segment. So I think as long as they have the cash flows to service the debt, I don't think that's much of a problem. We'll have to wait, as Samir rightly said, we'll have to wait to see how the restructuring turns out, because in the past also they have talked about restructuring the debt, but I don't think the debt has really come down. But I really wouldn't worry too much about the debt, because as I said, at this price levels, I think the valuation concerns are actually in favor of the company. So that's what actually we would be looking at in the stock.
Okay, so I think that's the view that's coming in on Trade Industries. Hari likes the stock. The others are on a wait and watch mode to see what the company does over the next few quarters before taking any kind of position or a recommendation on the counter. The other stock probably took the world by surprise, and that was Tata Motors, when everyone thought that everything is going downhill. It was interesting when Tata Sons themselves started accumulating. The counter didn't move that. They bought in average of over 3 crore shares at a price of almost 165 to 170. The counter is at almost 230 now. What's caused this rally, and what's the way ahead on Tata Motors? Samir, anything on Tata Motors? You track auto very closely. What, according to you, caused this rally?
So I think we were very positive on the Q3 numbers, because that was one thing pending as an investor when Tata Motors we used to look at, and we used to see the JLR balance sheet. There was a big overhang of these intangible assets, and they used to always create a depression in the P&L. So that was a good thing in the up cycle, but when the down cycle started, that was the main hurt for them. So I think by taking that one-time write-off, they did the better thing off. And over there, we were buyers as well. And I think now onwards, the only thing is their cost restructuring is taking place on the ground as well. So that is impacting the movement and the guidance which they have issued for Q4 as well. I think will be a better off, obviously, on a quarter-on-quarter, but on a YOY basis, I think the cash flow will improve at JLR. It improved last time also, but that was suppressed because of the 700 million bond buying they did. So I think over there are things improving at the JLR end. And if you see the domestic end, the passenger vehicle and the commercial vehicle, they're gaining market share for the first time in the passenger vehicle after long. So I think over there are things moving. It'll take some time. It might have run up a little ahead of it itself, but I think there is a room for improvement for them.
You believe fourth quarter will be good for Tata Motors this time?
It'll be better off. It will not be a great quarter or everything would have finished off. But I think
concerns on China and all still remain, or is that something?
China, if you see China, if you see till March, they have done a very big amount of stimulus in the system. So that if you see the data of April also, whatever has come out, that has pushed up construction movement, that has pushed up the industrial output, the industrial inflation. So that somewhere or the other, I think by July and August, somewhere or June, there will be a revival in the car sales, which I see. So I can be wrong over there, but mostly I see that trend happening over there.
Okay, what about you, Vinit? What's the sense you got on Tata Motors? Anything that you spotted that caused this massive rally?
So we've been bearish on the stock.
Okay.
We continue to be bearish. Reasons being that China drawdown of volumes is too large. And we don't think that the stimulus that China has done will take back volumes back to that level. So we recommend selling at every rally. Indian market is not going anywhere. The talk of the CV space or the PVs volumes are not tangible enough to contribute to any kind of bottom line growth. So given all these factors, I think Tata Motors remains a sell, and I think a better bet to look at would be TVS Motors.
You think that fourth quarter, they will struggle financially over the next few quarters?
Clearly, they will struggle. There are too many moving parts for that stock. It's the US, it's Europe, it's China, and India is not going anywhere for another year. So, the better story is JLR, because it was obviously 80% of the revenues. So, if you are tracking that, and if you think that the China market is not coming back, which we believe, I think there are some other stories to look at in the market. And, all of course, the bottom fishing has been done by the management, so the management does have a better handle on the news. But data doesn't seem to suggest that it's an investment story as yet.
Okay, what about you, Hari? What's the sense on Tata Motors that you have?
No, we like the stock. There are actually two ways to look at it. One is a very medium term and one is a longer term. From a short to medium term perspective, I think number one, the correction that happened in Tata Motors from about 590 to about 140, I think it was largely overdone. I agree there are worries on the domestic demand front, on the China front. But see, let's understand that in the past, whenever China has had a problem of growth, and we are talking about 6.3% growth in the first quarter, which is not a very a great number to look at. We are talking about credit crunch in China, so all these are not great news. But then whenever China has had a problem, one, they have come with the monetary stimulus. Today, I think the People's Bank of China is talking of a major fiscal stimulus, which will include tax cuts, public expenditure, subsidies, etc. So I think all this is going to translate into bigger demand. The second worry was Brexit. I think what has happened now is that with Brexit being postponed till September, the short-term concerns over Brexit are, I think, more or less over. There is going to be a cost of whatever 2 billion as far as the Brexit shifting is concerned, but whether it will happen, when it will happen, I think that's 6 months away. So the immediate concerns are out. I think Indian market is bottoming out. What we saw on the auto demand and auto stocks last year, 25% down, I think the worst seems to be over as far as Indian auto is concerned. So that should also be positive. I think broadly, if I look at it, we are betting on Chinese market reviving medium to long term. And if we take a slightly longer term perspective, I think even their big bet on electric cars, I think that's going to really pay off. As of now, I don't think it's going to be visible in the next 4 or 5 quarters. But the way Chandrasekhar has been talking about making a big shift to electric cars, especially on the JLR front, I think that's going to be a big game changer. So medium to long term, I think hard to give a kind of a return perspective on the stock, but I think any dips we find on Tata Motors, we'll be accumulating the stock.
Okay, so that's the view that's coming in, 2:1 in favor of Tata Motors, at least from our guest. And the final stock we want to talk about is the big results that came out on Friday evening. Infosys and TCS came out with numbers on the first day. Infosys continues to slide while TCS continues to move in higher. While both of the numbers were pretty much in line, I think Infosys disappointed much more. So Hari, is that the view that money is now moving into TCS because while both were in line, Infosys disappointed much more and TCS did what it had to do?
Yes, I think if you do a growth to growth comparison, I think one was 17%, the other was 10%. So definitely, I think in terms of growth, there is a disappointment. There is also what I call a mismatch in terms of the operating profit margins. I guess TCS has about 26% and Infosys is about 21%. But having said that, and if I look at the valuation that you give to a TCS and the valuation you're giving to Infosys, clearly there is a lot more of upside on Infosys compared to TCS. My worry on TCS is that I think most of the positives in the next few quarters are already priced in. So I don't know what an investor can get out of it. The only thing that Infosys needs to focus on, in my view, is attrition. Because I think if you have an 18% attrition compared to a 10.5% attrition for TCS, I think that's going to be one factor that is going to take away the traction from a stock price. So if Infosys wants to really give returns in the medium to long term, they need to get a hang of their attrition. I think once they get that right, I would be betting more on Infosys than on TCS as a medium to long term buy.
Okay, that's the view that will come in on Infosys versus TCS. Vinit, what sense did you get seeing the numbers? Would you be buyer in Infosys at this lower level, or would you back TCS?
So continue to back TCS, primarily because of a few things. Growth is very strong. Infosys struggles with growth. Every year we have them cutting guidance. Efficiencies are coming down. So Infi, the worst of margins is 24.9, the best of margins is 27. So it's in a very tight band. Infi from 24 to 22 has lowered the band to 23, 21. So that doesn't speak well on it. And they're saying we will go for growth at any cost. So when a company which does turnover which is almost 60% larger than you, okay, and continues to grow well with better efficiency, why would there be a need for Infi to go for growth at any cost? Second factor is that the employee wage considerations, their wage consideration are much higher, nearly 300 bips for Infi. So clearly the operating leverage is in favor of TCS. TCS is much larger than Infi. If you're sub 4 in Infi, TCS is at 8. And on such a large base, you're showing some very strong growth. And you have got good cash balances also. So I think that the ROIC is also very good for for TCS. So TCS is at about 40, Infi is at about 34%. So I think, clearly all the data on growth, efficiency and valuation metric clearly supports the TCS growth story.
Samir, what's your sense?
So I think I have a hold on both because Infosys right now is in an investment phase. And they're facing another issue, as Hari said, the churn. that attrition is 20%. Now if you see the balance sheets, the cash flow post buyback has remained flat for Infosys and turned towards degrowth in TCS. So I think the receivables are increasing for both. So I think there is a kind of a slowdown over there in the order book or the execution and the clients. I think which gives me a little negative outlook in the shorter term. So I would like to see next couple of quarters.
So it's a wait and watch actually, according to Samir, but I think what Vinit says that TCS at this point of time has the edge. But we have the management of Polycab Wire, but before that, let me thank my guest because we need to in Hot Money. Hari, thank you so much for coming in. Vinit, Samir, thank you so much for coming in. But before we end the show, Polycab Wire is listed at a substantial premium to its issue price of 538 rupees per share. We had a chance to speak to the management of the company post the listing, hear out what they had to say.
I just want to convey that we are on the journey of long-term stakeholder value creation. What we have performed in terms of the last 5 years in particular, taking the EBITDA margin of the company from 7.7% to probably 11.7% in FY18 and 12.7% if I look at the cable and wire business alone, because we were only a cable and wire company in FY14. And if I really look at the revenue ramp up of about 14.3% compounded in the last 5 years, I think we are on the path towards serving our shareholders well.
Okay, great. Talking about your distribution network, and that is the core strength of a company like Polycab, especially for your consumer business and the wires business, of course, how do you plan to really ramp up your distribution, and how do you see it count-wise by end of FY20?
You see, what we have actually achieved in terms of our consumer business is stupendous. Starting off with LED lighting, with fans, with switches, switchgear and conduit pipes, in FY18 we did a business of about 500 crore. And first 9 months of FY19 we are at about 460 crore. I cannot tell you what is the FY19 full year number. However, we have achieved this revenue with a tremendous amount of focus on own manufacturing. We have our own manufacturing for fans in Roorkee, for switchgear in Nashik, LED lighting in Baroda, conduit pipe in Baroda, and an OEM factory for switches in Bhiwandi. We are proud of the fact that today our total consumer business, wire plus consumer electrical, is a 2,000 crore business, actually 2,500 crore. And that is about 35% of our revenues. And that is something which we are very proud of. How do we plan to ramp up distribution? Today we have about 1,900 dealers and distributors who are with consumer electricals, and about 1,500 dealers and distributors who are on cable and wire, and 500 intersect. Okay. And that being the situation, this 2,800 strong dealer and distributor family with 1 lakh retailers is something that augurs very well for our future growth plans.
Okay, good to know that, sir. And talking about new facilities, since you have been expanding into consumer electricals, fans and other such consumer products, when it comes to the capital expenditure and capacity for all of these new products, how well is Polycab planned at this point in time, and what could be the capex for the next 1 or 2 years when it comes to the expansion of your wire capacity as well as your consumer good capacity?
See, Polycab always has believed in investing in a downturn. So we are a permanent bull in terms of India's GDP story. Right. Polycab's growth is linked to what happens in terms of India's GDP growth story. And we are one of the companies building tomorrow's India, whether it be from power generation to power transmission to power distribution, services sector, agri sector, construction industry, infrastructure. Polycab spans through its cables, wires. Moreover, with consumer spending, our wires as well as our consumer electrical products are reaching the homes and offices of people. What I'm very proud is that today we have a unique business model. 80% is sold through distributors, 35% of our business is B2C. Our dependence on B2B is just about 15 to 20%, and our exports are at about 5 to 6% of our revenue. And I think with this kind of a business footprint, we are well placed to be able to ensure good stakeholder value in the future.
Okay. And Ram sir, one final question on your operating performance. You said that you have been able to improve your margins, over the last few years or so. Talking about your margin performance moving ahead, how do you really see your EBITDA margins? Because you have been investing into distribution, into newer products, into newer facilities. Of course, there are setup costs relating to that. But on a normal trajectory basis, what is the targeted EBITDA margin range that you see moving ahead, given the fact that your product mix is changing and probably consumer electricals could be a bigger pie for the company moving forward?
7.7% was our cable and wire EBITDA in FY14.
Okay.
And cable and wire EBITDA in FY18 was 12.7%. So in 5 years, we improved our EBITDA by 5 percentage points. That is a very important improvement. Because our consumer electrical business is just 4 to 5 years old and we are in the investment phase there, that EBITDA margin was at about 3.3% for FY18. So the blended EBITDA was at 11.7%. First 9 months EBITDA is standing at approximately 13.7%. I am not offering that as a guidance for the future. I am only trying to say our focus is on revenue growth, market share gain, distribution expansion, building the brand, and we will do all of this while driving our gross contribution up. With a higher gross contribution, our absorption of overheads will improve, and as a company, we will be getting greater market share, greater shop share, and greater brand share. I think that is our mantra in terms of our success.
What is the meaning of this word?